Recession fears are spreading fast, market volatility is surging, debt is piling up, and warnings of another financial meltdown are flooding social media. But what if the real crisis isn't coming? What if it's already here? And this time, it's not the banks we need to worry about. The real threat is much bigger, hidden in plain sight, and unraveling right before our very eyes. At the center of it all is private equity, an industry that has quietly built a financial time bomb. They've taken out trillions in risky, adjustable rate debt, drained profitable businesses dry, and offloaded the fallout onto the American pension system. Unlike 2008, this crisis is buried inside private equity black boxes, making it hard to see, but not impossible. Thanks to some incredible research published by Tiffany Cianci on X, the foundation of this crisis is finally being exposed. The cracks are already forming, and if this bubble bursts, it won't just wipe out investors, it will take down small businesses, entire industries, and what's worse, the retirement savings of millions. So we're going to break down how this crisis is unfolding, who's pulling the strings, and what it means for the future of the economy. Because while most are bracing for a recession, the real collapse may already be underway, and those who don't see it now could be the ones left paying the price. For over a decade, the architects of the 2008 financial collapse have been quietly rebuilding their empire, this time with even greater ambition. You see, despite their role in triggering a global economic meltdown, they faced no real consequences. So instead of retreating, they adapted, learning a crucial lesson in the process. As long as the system remains rigged in their favor, they can extract wealth from it indefinitely. And with interest rates held near zero for over a decade post 2008, they were essentially handed a big fat blank check to borrow, expand, and consolidate power. But this time, they had a new strategy, one that nobody would see coming. While most people go about their daily lives focused on work, family, and the rising cost of living, private equity firms have quietly embedded themselves into nearly every single corner of the economy. They don't just own real estate, luxury brands, or investment funds. They now control the businesses people rely on every single day. Retail chains, hospitals, veterinarian clinics, nursing homes, construction companies, and even emergency rooms. On the surface, these companies appear to be independent, but behind the scenes, they have been swallowed up by private equity giants with one goal: extract maximum profits no matter the long-term consequences or the diminished returns for the end users. Their method is simple: leverage. When private equity acquires a company, they don't use their own money. Instead, they load the business they buy with massive amounts of debt, often through adjustable rate loans. At first, this debt may seem manageable, but there's a catch. As interest rates rise, so do those loan payments. This forces businesses to cut costs, raise prices, or collapse entirely. And that is exactly what is happening today. The Federal Reserve's rate hikes over the past 3 years have sent borrowing costs soaring, pushing private equity's fragile financial model to the brink. Every 30 to 60 days, loan payments reset, climbing higher and higher until even profitable businesses can't keep up. And this isn't speculation, it's already happening. For example, Jo-Ann Fabrics, a company where 90% of stores were still profitable, just filed for bankruptcy. Hooters, a well-known restaurant chain with steady revenue, met the same fate. In 2024 alone, over 110 private equity-owned businesses collapsed, nearly double the previous record. This isn't just an economic downturn, this is a controlled demolition of the American economy, unfolding faster than anyone can expect. But of course, private equity isn't doing this alone. The banking system is fueling the entire operation, and they aren't just issuing these risky loans, they are making sure the risk falls onto someone else. Rather than holding on to this toxic debt, banks are repackaging it into something far more dangerous: collateralized loan obligations, or CLOs. If that sounds familiar, it should. This is the same blueprint they used in 2008 with mortgage-backed securities. Back then, they bundled risky subprime mortgages together, stamped them as safe investments, and offloaded them onto pensions, retirement funds, and institutional investors. And we all know how that ended. But this time, they're taking it even further. Instead of bad mortgages, they're bundling up private equity's mountain of unsustainable corporate debt, trillions in high-risk adjustable rate loans, and disguising it as a stable investment. These CLOs are being funneled directly into pension funds, the very institutions responsible for securing the retirement savings of millions of Americans. And what happens when those loans become unpayable? Businesses collapse, workers lose their jobs, and the pensions that people have spent decades paying into are left holding the bags. Now, I might be a little too young to remember, but back in 2008, this is exactly what occurred, but this time it's way worse. Back then, risky adjustable rate mortgages totaled about $2.4 trillion. Today, private equity holds $3.8 trillion in similar high-risk debt. But this isn't just a housing bubble. This is a financial time bomb embedded into nearly every essential industry: healthcare, retail, construction, infrastructure. And when it comes all crashing down, it won't just be investors who suffer. It will be everyday Americans, the very people who had no say to any of this, watching their pensions, their savings, and their future evaporate in real time. Although this may seem like simple incompetence, private equity firms aren't just reckless, they are calculated. They know exactly what they're doing, and they know exactly who will be left holding the bag when it does collapse. By shifting the risk onto the pension funds, they've essentially ensured that when the fallout hits, it won't be them paying the price. But at the same time, governments won't let millions of retirees go broke. Just like they couldn't let the banks collapse in 2008, the Fed will be forced to turn the money printers back on in order to save the economy. But this time, the bailout won't be for Wall Street, it'll be for the pensions that private equities deliberately poisoned with toxic debt. And unfortunately, this is all really possible because the system is rigged in their favor, protected by a loophole so blatant it's almost insulting. The carried interest loophole is the golden ticket that allows private equity firms to dodge taxes, manipulate financial markets, and operate with almost no real oversight. Congress has tried to shut it down before, but every time private equity slips on in and influences how the change is made. Recently, Donald Trump made waves by vowing to close the loophole once and for all. But will it actually happen, or is it just another political promise destined to fade the moment the cameras turn off? Because if this loophole stays open, the cycle will never end. More businesses will be gutted, more workers will be left jobless, and more pensions will be looted before the reckoning finally comes. Alright, so enough doom and gloom. What are some actionable steps that we can take to mitigate the downfall for ourselves? While the private equity debt bubble poses a serious risk to pensions and the broader economy, of course, it's not guaranteed to affect you. Pulling your pension funds entirely definitely isn't the best answer. Instead, gaining a deeper understanding of how your company's retirement plan is structured can help you make a more informed decision. Research where your pension funds are allocated, whether they are exposed to risky private equity investments, and if alternative options exist within your plan. Diversify personal savings into assets like Bitcoin, which operates outside traditional financial markets if you want it to, or gold, a reliable hedge against inflation. This can provide additional security. Keeping some savings liquid, low-risk investments, and considering real estate with fixed-rate loans can also help shield against economic uncertainties, although the housing market is a whole other story. Regardless, as inflation and financial instability rise, staying informed and proactive is key to protecting your financial future in a system that often shifts risk onto everyday Americans. Americans. Now, as you can see, this video wasn't necessarily for the lighthearted, but regardless, if this applies to you, you need to remain proactive and self-aware, or you could be the one holding the bags. And not the good bags either, the ones that are worth nothing. The future of the American economy is hanging by a thread, and most people don't realize it. Now you do, so pay attention. While the media focus on stock market swings and speculation over the next recession, the real collapse is unfolding beneath the surface, engineered by the same financial elites who never faced consequences for doing the same exact thing in 2008. The economy may be built on a rigged system, but history has proven time and time again that no system, no matter how entrenched, is immune to change. The first step is recognizing the problem, and the next step is making sure those in power can't ignore it. Because if we do nothing, the bill will come due, and when it does, it won't be Wall Street that pays the price, it'll be us.